The halt that shouldn't have happened. Silver was pressing into breakout territory near 91.30, leaning against a level that had capped rallies for months. Momentum was constructive. Volatility was controlled. Then, without warning, trading halted. For 90 minutes, price discovery stopped. Orders froze. Liquidity vanished from public view. When the market reopened, silver did not auction gradually lower or probe for balance. It dropped vertically to 88. No bid ladder, no measured retracement. Just air pockets. This is where the contradiction begins. On paper, liquidity is deepest when participation is broad. Yet during a critical technical test, the paper market paused entirely. Meanwhile, physical premiums remained firm in key regions. Retail coin spreads did not collapse. Asian benchmarks did not signal panic. Two realities coexisted: frozen derivatives, steady physical demand. If liquidity was stable, why did repricing occur in a vacuum? If inventories are ample, why does stress seem to surface near delivery windows? These are not accusations. They are structural questions. Markets rarely fracture during quiet consolidation. They tend to break near inflection points, when positioning is stretched and timing matters. This event deserves analysis, not outrage, because understanding the plumbing behind the pause is more important than reacting to the headline. Immediate context and event breakdown. In the hours leading up to the halt, silver was testing a critical structural ceiling near 91.30. That level had repeatedly rejected prior advances. A sustained move through it would have opened a path toward 92 and beyond, forcing reassessment among short-term traders and systematic funds. Instead, the exchange announced a technical issue and halted metals trading. Natural gas contracts resumed within a shorter window. Silver and the broader metals complex remained paused significantly longer. When trading resumed, repricing was immediate. The contract fell more than $3 in minutes, slicing through intraday liquidity and printing near 88 before stabilizing. There was no extended auction process, no gradual discovery of value. The move occurred in a vacuum created by the halt itself. Technically, 89 had recently transitioned from resistance to emerging support. That level now becomes structurally important. Above, 92 remains the breakout threshold that would pressure concentrated positioning. These are not arbitrary numbers. They reflect areas where positioning and risk management decisions converge. At the same time, public inventory reports show COMEX registered silver trending toward approximately 86 million ounces. Open interest remains elevated relative to that registered supply, a relationship that warrants monitoring even if delivery intentions remain uncertain. Meanwhile, Shanghai premiums continue to trade above Western spot benchmarks, indicating persistent regional demand differentials rather than synchronized weakness. The timing adds context. The halt occurred days before first notice and during the roll transition from the front month. Historically, these windows concentrate positioning adjustments and liquidity shifts. Spreads had begun tightening, suggesting sensitivity in the forward curve. None of these data points alone prove intent. They do, however, confirm that the interruption happened during a structurally sensitive period. Stress timing does not equal manipulation, but it does justify deeper examination of market plumbing, positioning, and delivery mechanics, because inflection points often reveal structural vulnerabilities that remain hidden during calm phases: data stack and market plumbing. To understand whether this event reflects noise or structure, we have to move beyond price and into plumbing. The first layer is open interest relative to registered inventory. Public reports show registered silver hovering near 86 million ounces. Each standard COMEX silver contract represents 5,000 ounces. If open interest in the active month implies claims on multiples of that registered pool, the leverage ratio becomes clear. For example, 20,000 contracts equal 100 million ounces. The exchange is not designed for all contracts to stand for delivery simultaneously, but the comparison illustrates structural exposure. This is not conspiracy theory, it is arithmetic. The distinction between eligible and registered metal matters here. Eligible silver sits in approved vaults, but is not designated for delivery. Registered metal is specifically warranted and available to meet futures delivery obligations. Metal can move between categories, but the designation reflects readiness. When registered stocks trend lower while eligible remains stable, it signals preference, not disappearance. Still, delivery optionality narrows as the registered category declines. Vault flow reports provide additional texture. Daily withdrawal data show when metal exits the registered pool or leaves vaults entirely. Persistent net withdrawals, especially during active delivery months, indicate either strong off-exchange demand or reclassification ahead of settlement. Neither interpretation implies default risk. Both imply that physical flows deserve monitoring alongside paper positioning. Concentration reports add another dimension. When a small number of traders control a significant share of short exposure, positioning becomes more sensitive near technical breakpoints. Large concentrated shorts are not inherently manipulative. They are structural participants, banks, hedgers, liquidity providers. However, concentration increases the mechanical impact of a breakout through key resistance levels. Spread behavior reinforces this plumbing analysis. In normal conditions, silver trades in contango, with future months priced above spot to reflect storage and financing costs. When contango narrows aggressively or the curve flattens toward backwardation, it signals tightening near-term supply or elevated demand for prompt metal. Spread compression does not guarantee shortage. It does indicate stress sensitivity within the forward curve. The volatility response after a halt also follows mechanical logic. When trading pauses, resting orders vanish. Liquidity providers widen spreads. Upon reopening, even moderate market orders can trigger outsized price movement because the order book is thin. The vertical drop following the halt reflects this dynamic. Thin liquidity amplifies directional pressure. Exchange enforcement patterns also warrant attention. Position limits exist to prevent systemic imbalance. When exchanges increase monitoring, adjust margins, or suspend accounts for violations, it signals that concentration has reached thresholds requiring intervention. These actions are procedural, not ideological. They are designed to maintain clearing stability. None of this implies hidden hands. It illustrates how a leveraged derivatives market interfaces with a finite physical inventory. The structure functions smoothly most of the time because only a fraction of contracts convert to delivery. Stress emerges when leverage, timing, and positioning converge. The data is public. Vault reports are published daily. Open interest is transparent. Spread charts are accessible. Rather than relying on narrative, pull the reports yourself. Compare registered stocks to active month exposure. Monitor roll volume. Observe spread compression. Market plumbing rarely appears dramatic until it matters. The mechanics are visible for those willing to examine them. Structural explanation layer. To understand the recurring tension between price behavior and physical narratives, it is essential to separate function from expectation. The futures market exists primarily for hedging, leverage, and liquidity transfer. It is a risk redistribution mechanism. Producers hedge output. Fabricators hedge input costs. Speculators provide liquidity and assume price risk. The system clears efficiently because only a small percentage of contracts ever result in physical delivery. It was never designed for universal conversion of paper claims into bullion. The disconnect emerges when observers treat futures open interest as if it represents immediate claims on vault metal. It does not. It represents risk positions that can be offset, rolled, or cash settled. Under normal conditions, this layered structure operates without friction because leverage is absorbed through netting and offsetting trades. Structural tension arises when three elements converge. First, leverage remains elevated relative to registered inventory. Even if delivery intent is low, perception of coverage tightens when the ratio expands. Second, the calendar advances toward delivery month. As first notice approaches, participants must declare intent, stand, roll, or offset. This compresses decision windows and magnifies sensitivity to price moves. Third, volatility increases. Higher volatility raises margin requirements, forcing capital adjustments that can cascade through leveraged books. When these forces align, stress does not begin with headlines. It often begins quietly within spreads. Contango narrows. Forward months stop behaving normally. Liquidity providers demand wider compensation. Occasionally, exchanges experience operational strain precisely when positioning density is highest. That does not imply causation. It reflects the reality that complex systems are most vulnerable at inflection points. Historical delivery squeezes across commodities rarely start with declarations of shortage. They begin with distortions in the forward curve, abrupt volatility expansions, and shifts in margin dynamics. Participants reposition defensively. Shorts reduce exposure. Longs reassess carry economics. Clearinghouses adjust collateral thresholds. What typically breaks first in stress cycles is not the vault door. It is the pricing structure. Spreads invert or flatten aggressively. Margin requirements rise to contain risk. Volatility expands beyond historical norms. These adjustments are stabilizing mechanisms, not signs of imminent collapse. They redistribute pressure. The current episode fits within this framework of structural friction. A trading halt during a technically sensitive period, followed by abrupt repricing, is consistent with liquidity imbalance under elevated leverage. That does not guarantee escalation. It highlights sensitivity. Understanding this architecture is critical. Futures markets amplify moves because they are leveraged by design. Physical markets move more slowly because they are constrained by transport, fabrication, and capital cycles. The gap between the two widens during stress. The question is not whether a squeeze is inevitable. The question is whether positioning, timing, and volatility are converging in a way that elevates fragility. To answer that, we move from structure to timing, because stress windows are defined by calendars as much as by charts. Countdown, POSH, pressure window. Structure becomes most sensitive not at random moments, but at defined calendar checkpoints. In silver futures, first notice day marks the boundary where longs must demonstrate capacity to take delivery, and shorts must be prepared to issue warrants. Into that window, positioning compresses. Participants either roll forward, offset exposure, or stand for metal. That decision cluster creates a pressure zone measured in days, not months. The roll window intensifies this dynamic. As traders migrate from the front month into the next active contract, liquidity shifts along the curve. If open interest remains elevated while registered inventory sits near 86 million ounces, scarcity math becomes visible. For example, if active contracts represent claims several multiples of registered supply, most will roll. They must. The system assumes it. Stress emerges only if an above normal percentage chooses to stand. Short covering risk increases near technical inflection points during this period. If price approaches resistance while delivery decisions are pending, concentrated shorts face dual exposure, mark-to-market pressure and delivery obligations. Even without physical shortage, that alignment can produce volatility spikes. Exchange for physical transactions add another layer. EFP allows futures positions to transfer into off-exchange physical settlement channels, easing visible pressure on COMEX inventories. Rising EFP volume can relieve stress or mask it, depending on participation. These windows are brief but impactful. Markets do not need to break for tension to matter. They simply become more fragile. As we move deeper into the settlement cycle, timing converges with structure, and that convergence is where macro forces begin to matter. Macro overlay. While delivery mechanics define the pressure window, macro conditions determine whether that pressure dissipates or accelerates. The dollar index remains a primary variable. A firm dollar tightens global liquidity and historically weighs on metals pricing. A weakening dollar, particularly during fiscal expansion or trade friction, reduces the opportunity cost of holding hard assets and increases sensitivity to structural stress in futures markets. Federal Reserve rate expectations compound this dynamic. When policy uncertainty rises or markets begin pricing rate cuts into forward curves, real yields become the focal point. Silver responds less to nominal rates and more to real yields adjusted for inflation expectations. If inflation expectations stabilize while nominal yields fall, real yields compress. That compression historically supports monetary metals. Oil prices add an industrial dimension. Sustained energy strength feeds into input costs, transportation, and fabrication expenses, reinforcing inflation expectations and pressuring real yields. Conversely, collapsing energy prices often coincide with demand contraction, reducing industrial silver consumption and relieving some upward price tension. Geopolitical instability layers another variable. Sanctions regimes, trade fragmentation, and regional conflict alter capital flows. In such environments, sovereign reserve diversification becomes more visible. Central banks have increased gold accumulation in recent years. Silver does not benefit directly at the sovereign level, but it tracks the broader hard asset sentiment that accompanies reserve realignment. Silver occupies a hybrid role. It is both industrial input and monetary hedge. That dual identity amplifies macro sensitivity. When growth expectations rise, industrial demand supports pricing. When monetary uncertainty rises, its hard asset narrative strengthens. If both occur simultaneously, elevated geopolitical risk alongside inflation persistence, the leverage embedded within paper markets becomes more fragile. Macro is fuel. Structure is the ignition system. Without macro acceleration, structural stress can resolve quietly. With macro pressure building, even minor mechanical imbalances can expand rapidly. Understanding how these forces interact defines whether the current window represents temporary volatility or the early phase of broader repricing. Bull case. The upside thesis does not require collapse of the exchange. It requires persistence of current structural signals. If registered inventory continues trending lower while open interest remains elevated into active months, leverage stays visible. That ratio alone does not force delivery stress, but it narrows the margin for error. Add sustained spread compression, contango flattening toward neutral, and near-term supply sensitivity becomes more pronounced. If macro volatility increases simultaneously through dollar softness, falling real yields, or geopolitical escalation, risk models adjust. Higher volatility raises margin requirements and reduces tolerance for concentrated short exposure. In that environment, a technical break above 92 becomes more than a chart event. It becomes a positioning event. Shorts managing leverage would need to hedge or reduce exposure. Algorithmic funds would respond to momentum signals. Retail participation would likely increase on confirmation of breakout levels. This sequence does not require panic. It requires mechanical response to price expansion. Persistent Shanghai premiums would reinforce the perception that physical demand remains stable, limiting downside confidence among sellers. The result could be an orderly but rapid repricing phase driven by short covering and systematic inflows rather than disorder. This is not an explosive inevitability. It is a scenario in which structure and macro align, and resistance failure converts latent pressure into directional momentum. Bear case. A disciplined analysis also has to respect the downside path, because most stress signals resolve without breaking. The simplest bearish outcome is that the roll cycle succeeds in relieving front-month pressure. If open interest migrates cleanly into later months, the delivery window passes without abnormal standing, and the leverage ratio becomes less relevant in the immediate term. In that environment, registered inventory can stabilize through reclassification from eligible or through reduced withdrawal activity, reducing the sense of tightening. If Shanghai premiums narrow at the same time, it suggests the regional physical tightness narrative is cooling, whether due to improved supply flow, softer demand, or changes in local pricing conditions. That would remove a key support pillar for the physical versus paper divergence argument. Macro can also turn against silver quickly. A sharp dollar rally, driven by risk-off flows, higher U.S. yields, or renewed Fed hawkishness, typically pressures metals. If industrial demand softens through slower manufacturing activity, weaker electronics demand, or broad commodity deflation, silver's hybrid identity becomes a vulnerability. It loses monetary tailwind while also losing industrial bid. Technically, that environment produces churn rather than trend. Price can retest the former breakout zone near 89, and if it fails, drift lower as liquidity returns and volatility compresses. None of this disproves structural concerns over longer horizons. It simply describes a common outcome. Pressure windows pass, markets normalize, and the next decision point shifts forward on the calendar. Data recap compression. 90-minute trading halt as silver pressed key resistance near 91.30. Immediate $3 drop on reopening, reflecting thin liquidity conditions. Registered inventory hovering near 86 million ounces. Open interest elevated relative to deliverable supply. Settlement window and first notice day approaching. Forward spreads tightening. Persistent premium between Eastern benchmarks and Western spot pricing. Dollar and real yield volatility rising alongside geopolitical uncertainty. None of these data points alone confirm systemic stress. Together, they define a structurally sensitive environment. Data matters more than narrative, and positioning matters more than headlines. The structure is visible for those monitoring it closely. Disciplined close. This analysis is education, not investment advice. Markets reward patience, structure, and disciplined risk management, not emotional reaction. Verify the data yourself. Monitor positioning and spreads objectively. Think in probabilities, not certainties. In volatile environments, logic must outweigh hype.